Good morning, guys. It is Sterling here from Day Trading Forex Live, and what we're going to do here is just walk through the entry that I had and the actual entry. Let me check here. So the actual entry price I had was 07 and 2/10, and I'll also put the actual order entry up in this case. But in this specific situation, I ended up with a 10 pip stop. I have an open take profit on this for the time being, and I have an open take profit. The reason being is that this has, to me, the possibility of much further downside after the really aggressive reversal here, which I have a trade set up that I need to do a video on as well. I had a couple entries on this short through here after kind of a similar setup to the other video I put out recently on US GDP when I had taken that short on US GDP after the news was creating the stop run. It was a very similar principle here. There's maybe a little more risk in that situation as you're going after a market that tends to be a bit more volatile. But in this situation, I'm using that information from the prior day. So context about the prior day is giving us an indication of what's going to happen potentially today and moving forward. In this case, this information here tells us that they were very strongly selling into any remaining buying pressure that was left. It also gives us a very good indication that when you get a move that's this size, that especially has started with such a large and clear break of a previous high that gets rejected back down, those type of larger moves tend to have follow through the next day. They tend to have a higher probability of seeing further continuation in that direction. That's why I'm open to a little bit larger take profit in this scenario, but the fact is we're still relatively close to the entry, only about 3.5 pips away from the entry, so it's got a fair bit to go. But let's walk through the reason. We talked a little bit about yesterday in that context, so that's important to carry over. It gives us our short bias, and so from there it's just a matter of determining where are we taking the entry, where are we actually pulling the trigger. So to break that down, the basic idea that I was looking at here was anybody that is on the short side of the market, so anybody that is short, you start getting, and through this move down, it's very difficult to place stops. I mean, you're arbitrarily placing stops somewhere along this move down as people are shorting. But once you have a high that's created, and I'm not trying to say it's at any of those locations, I'm just illustrating that likely people are they're trailing stops down as the price goes in that direction. They're continuing to do so, and no doubt it's all different locations varying throughout the move to the downside. But the one thing that's really nice about previous structure in the market, or something forming after you don't really have a previous, in this case a previous high to go off of, because the fact is nothing condenses liquidity like a previous turning point in the market, and nothing is more attractive for liquidity, but either for an entry as well as an exit as a previous turning point in the market. So when the market makes that big of a sell-off, you got to think about anybody on the short side and their likely stop location. Well, you get this high created, you then work off that high. You don't know that the market's going to create that as the Asian high, but once it does, what that is giving anybody on the short side of the market is it's giving them some structure. It's giving them a previous high that they didn't really have before to place stops beyond, and that is by far the most common way of placing stops, looking at previous structure in the market. So when you get that high created, that gives everybody on the short side of the market a much more clear option for stops to be placed. So now I say to myself, okay, well, if we get a break of that level and we reject back down, that's going to give us an indication of a move to the downside, and I'll want to get short. So I was looking originally, and by the way, for those of you guys that are members, last night in the preview, you'll know that the level here at 1208 kind of it correlates to the level we were actually using in the preview, which is right here. It was up a little bit higher. And the level we were using in the preview, because at the time I was doing the preview, we didn't have this high that was created. Either way, the result is the same. You did not get a valid confirming entry, hence the point of this video. What's another opportunity we have to take an entry from that point? Well, when I noticed the break above the highs, and again, I'm coming in, I was looking at the market about 6 a.m. my time here this morning, which is 6 a.m. Eastern. But when I came in and I was looking at the market somewhere around this time, actually it was down here because I was thinking about doing the video, which I should have done, talking about my entry place up here, but either way we're around the entry now, so it really doesn't matter too much. And what I really focused on was the fact that you broke above these previous highs, and ultimately that move, that break, ended up failing. That failure, that break of a significant level, the only real high in the area, gives us an indication that at the very least the market was testing further upside. Whether the intent going into it was to sell into it or not is not really relevant. Now, likely the intent was to sell into it, as this previous day's price action, as we discussed earlier, that momentum will typically carry over when it's that aggressive. Keeping that point in mind, with that point in mind, when I see another short-term rejection of higher prices and I see smart money selling into the buying pressure, why do I say they're selling into the buying pressure? Well, they weren't buying into that move. The price would not have slid to the downside if there was not further pressure on the market. If the vast majority of traders were buying at that point, the vast majority of the liquidity was long side at that point, the market's going up. Basic supply and demand here. So seeing the break above that level, in combination with the fact that they started the market to the downside, which is very typical, start it in the direction you're ultimately going to go, then run back, tag anybody out who was in that original position. They're getting tagged out on the break through those highs. In addition to anybody that's short who likely trailed stops beyond the last high, which is right here. And when I see that short-term break and then falls back down below it, to me, what it becomes a very high probability first touch entry, and this is a good example of where I take it on a first touch, and that is when we pull back to essentially where that move started. The way I mark where a move starts is I mark it as the first failure point. So first failure point would look like this. In this example, I'm drawing out the market is moving to the upside. You can see that I'm drawing out consecutively higher highs and higher lows. And what I deem as the failure point is the first kind of sequence, or the first time where we fail to continue setting those higher highs or lower lows, depending on the direction of the market that you're looking to trade at that time. But in this case here, that would have been the failure point, or if it had broken, that'd be the last low that was holding. So each time you kind of set a new one, I'm stepping it up, and essentially what I deem as the first failure is the point at which we break through that last, in this case, low. If it was a move up, or move down, I was describing, it would be the inverse. So when we break that last low and we come and retest it, essentially I'm counting on that as the point to hold in expectation of seeing further prices to the downside, a further slide to the downside. But I take the entry at that, and I deem that as the first failure point, because it's the first point at which you've now broken a lower low than the last low or last retracement low, and you're retesting that point. That's how I deem that as the first failure point, and where I'm looking at taking that first touch type entry. And I don't use a confirmation entry in this situation because there's more to the entry. There's other factors involved in that, and in this case here, I'm trusting the fact that you had the previous stop run and aggressive move down indicated very heavy selling the day prior. You then set a high, which you didn't have before. That gives traders a likely stop location. You then see them take out that stop location. Not only take out that stop location, but it's not that they took out the stop location and continued up. That gives us a very different signal. But what they did is they took out the previous highs and then reversed the market to the downside, proving that as another false break above the previous highs. Therefore, when you come back into what I deem as kind of the first failure point, or retesting where that short-term move up started to fail and work its way down, I use that as the first touch, or an entry location for that first touch. The nice part about that is it gives you a very high reward to risk ratio. In this case, sitting on a 10 pip stop with an 07, I think it was 07 and 2/10, something like that. As I always do whenever I talk about an actual entry, I'll show you guys the actual order for the entry. When I go back and edit this video, I'll put that in there so you can see it. But again, it gives you a very high reward to risk ratio where in this case, if we continue to the downside, if we do see a further breakdown, looking at kind of the larger perspective, well, you could be very easily sitting on 3-to-1, 4-to-1. And I think there's a little bit more possibility here if we are going to break down and why I'm holding it for a bit longer. The other example that we had a few days ago on the dollar yen, that was a great example as well of kind of a little bit different scenario where we're in the midst of news. So I tend to be a little more conservative in that situation. If I'm taking the entry and it gave me 2-to-1 as it did, you'll see that I took profit relatively quickly. In this case, there's some bigger things happening, larger stop run from the day prior, some further indication of short side move, and also just a general bias to the downside on the euro. I mean, look at the daily chart, pretty straightforward here. So all that kind of combined is what's leading me to say in this one specifically, I'm going to hold it for a bit longer. But that's the basic overview, guys, of this entry, why I was looking at the short side to begin with, based on the previous day's price action, combining that with some short-term manipulation on a smaller time frame chart. You can see this on the 5-minute, 15, whatever chart you're looking at. Between those two, it really doesn't matter. I prefer the 5-minute personally for this type of entry. But when those two are combined, gives you a very good indication. And at the end of the day, let's say this trade's a coin flip. Let's say you win this trade 50% of the time. Well, there's a hell of a reward to risk ratio behind this trade. I would take this trade every single time if it only won 40% of the time. Do the math sometime, guys. This is the greatest myth in trading, in my opinion. It's the greatest deception in trading. All these marketers that pretend to be traders and they market their strategy. It's the greatest way to know if you're dealing with a real educator or not. If they pitch their strategy based on a very high win-loss ratio, I can tell you with 99% certainty they are a marketer. They're not a trader. The best traders in the world never, ever talk about win-loss ratio as the key to their success. They just don't do it. What they do all talk about, though, is they talk about reward to risk ratios and risking significantly less than what they intend to make. A great example of that, guys, there's a book, and I don't really care what you think about Tony Robbins. Some people have a problem with me referencing Tony Robbins for some reason, but the guy had access to a lot of people that you and I would just not have access to. People like Warren Buffett, your different hedge fund managers, household names, names you hear in the news. And he talked about it in his book called Money Master the Game. And what I thought was really funny about that is that I've been saying literally for years, that's the best way to identify a marketer versus a real trader. They're going to talk about their win-loss ratio. As I said, I know one guy that really focuses a bit more on win-loss than reward to risk, and he's profitable. But it's more the exception than the rule. So anyways, getting back to what I was saying, the point that they all made in this book, and he interviews a ton of people, but it was really funny. There's one thing they all had in common. They had different strategies. They had different ideologies. They had different markets they traded. But there was one thing that was always the same with all of them. And they mentioned, or what was mentioned, was asymmetrical reward to risk ratios. And that just means that if you're risking $1, you want to make back 2, or you're looking to gain 2, or if you're risking $1, you want to gain 3 or 4. And every single one of them mentioned reward to risk or asymmetrical reward to risk ratios. Literally every single one of them talked about that as a critical aspect to their success. But what's even more telling than that is not a single one of them mentioned any idea of I'm right more than I'm wrong. Think about that for a second, guys. These are the biggest players in the business that we're in. And it's not just little old Sterling. That's, I have 15 years trading experience, but these are big guys. These are guys that have been around every form of market. I mean, any possible trading scenario. They have just a decade's worth of success. And they literally don't even mention win-loss ratios, and it's 100% their focus between those two is on reward to risk. And the math is very simple behind it. Do the math sometime. A trader that wins 70% of the time with a 1-to-1 reward to risk ratio is actually far less profitable than a trader that wins 50% of the time with a 2-to-1 reward to risk ratio. It's not that they're even, it's that the trader winning 50% of the time is far more profitable. So remember, guys, it's, ego can get in the way of profit. But your goal in this market is not to be right. That's not your goal. I know that sounds odd, but it's really not. Your goal in this business is to make money, right? I think we'd all agree with that. What I'm getting at is you need to put the focus on making the money rather than the ego of, oh, I need to be right more than I'm wrong, and Sterling's just talking BS because his strategy doesn't maintain a really high win-loss ratio. And you can think that, but what I would ask you to do is I would also ask you to verify whether that's true. I talk with the best traders in the world, read books from the best traders in the world, talk with those that have a lot of experience in the market and you know they're a successful trader. What are they preaching to you? And it's not going to be win-loss ratios. It's going to be reward to risk. That's such a major part to this strategy because I take entry on the first touch. I mean, I'm right at my entry right now. I think it was, again, 1207 and 2/10. And I have a beautiful 10 pip stop on that. I mean, you don't get much better for reward to risk ratios. It allows you to go in with a heavy position you might not otherwise use and really capitalize on the reward to risk potential of the setup. So I'm going to quit running my mouth as it's already pretty darn close to 20 minutes here, and I will be back for the wrap up to the trade. I'll see you guys in 5 minutes or 5 hours, whenever it wraps up, with either a stop loss hit or a take profit. All right, see you guys shortly. Alrighty, guys, so I'm back for the conclusion of this trade, and just to kind of walk through the wrap up here, I'm coming back a day later just because I didn't have time to do it at the time I was actually closing the trades. But again, you saw the entry on this, and I'll repost the exit as well. As far as the price goes, it was 81 and actually I had it marked here. It was like 81 and 7/10 was half, and I took the other half before I ended up going to bed at I think it was 74 and 1/10. Again, I'll put both exits up there in this case here, but I don't typically split positions, but the way that this thing was breaking at this time on the euro, I just felt like we had a lot more downside potential. You had this huge daily pin, which I'm not really concerned with the price action signal necessarily. I'm just illustrating the rejection of higher prices in addition to breaking of a significant major low. But the other side of that is I'm always suspicious of breaking a fresh low or breaking a fresh high, because at the point where everybody is selling, that's where the market's going to tend to go up. At the point where everybody is buying, that's the point where the market's going to tend to go down. So there's a couple trades on here today that go along with that. But on the initial break, when we broke through and we're kind of coming back up and testing, that's what I've been battling back and forth in my mind. How do I really view that? And especially with today's close, I wouldn't be shocked if we had a little bit larger bounce, ultimately, even if it does break to the downside. But anyways, going into the exit here, ultimately I was taking the first exit purely based on reward to risk. I went into the trade with a 10 pip stop, as I had mentioned, which, just to recap, the reason for that trade was the false break above the Asian highs, inducing the further buying pressure that was sold into. It was sold into, and that's visible that it's sold into when you get the actual move out of it. Obviously, they weren't buying on the break of that high. If you had much more demand in the market at that point, you would have had the market rotate to the upside instead of pushing back down. And that all is in the shadow of this larger, much bigger stop run from the day prior that occurred on the reversal after some FOMC comments were made, and the market made a snap reversal on that after about 30 minutes of digesting and essentially driving against the the first direction on that news, which created the first stop run for us. That gave us the looming bias of short, and then when we saw another short-term manipulation or short-term stop run move, that facilitated for me what I term as a first touch entry. It's a little more aggressive than my standard confirming entry, but as I talk about in the video, what I mean by first touch entry is when we retest what I term as the breaking point, and I would deem this as the breaking point because if the market is going to move down, if the market's going to start to move down off of a stop run, well, then it moved up first into the level. And then if we're going to look for a stop run short, we obviously would look for it after it moves again up into the level. So the first failure point of that short-term move up is the first sequence of lower lows, lower highs, and that's why I call that the first failure point. So when we retest that last low that was holding, that right there represents a very high probability entry, or a very high reward to risk entry, I should say. Because for me, even if the win-loss on that's around 50%, the reward to risk is so good, I'm happy to take that trade every time. And I'm not saying necessarily you should expect 50% or whatever percentage. I'm just simply stating a mathematical fact. If that setup hits 50% of the time and it's on a 2-to-1 reward to risk ratio, it's mathematically just a very profitable entry. So in this case here, love that type of entry because it gives you an exact level to risk off of, and you know that if that point is broken, because you're taking it on a first touch, again, you get that really good reward to risk. But you know that if that level is breaking, well, then your opinion, your bias, your thought process for that trade breaks down. So you don't need a huge stop. In this case, I was able to get away with a 10-pip stop, as I talked about on the entry of the trade, and that left again, 2.5 to 1 reward to risk ratio take profit on the first half. The other half was around 33 or so pips. So 3.3 on the reward to risk, and overall reward to risk of say 2.7, 2.8. Overall, nice setup there. And ultimately, I did end up having a long on, actually, no, sorry, it wasn't a long on the euro. We had this aggressive stop run on the lows that snapped back. It was a short on the dollar Swiss. I like the Swissy a little bit better. But basically, it was the exact same thing across a lot of these dollar pairs. And the dollar Swiss here specifically had this run and break of the highs. So it had this really aggressive candle on news this morning, breaks the highs. Same situation with news. It's the initial move on the news, and then when that initial move gets sold into, or if it's a move down and it gets bought into, I love the rejection of news. I will trust if news gets rejected, if news ends up being or serving as a false push, I always love that type of setup. So ultimately, when it broke through that low and kind of retested on the backside, I took it as a short-term trade, as I was expecting them to come down and tag this level at the very least. The reason I would expect them to come for that level, even if they're going to drive the market up ultimately, even if they're going to see the market push to the upside, it's the old principle of, the market doesn't move in straight lines. And when it gives every signal that it's going to break to the upside, that's generally when it's going to break down. Come tag everybody's stop that was long, get them out of the market, then maybe drive in that direction ultimately, but get everybody out, or at least have a good shake of everybody that is long before actually driving the market long. What that does pisses everybody off once they're stopped out. What happens if you're long, you get stopped out and you see the market going in your direction? I'm sure all you guys can look at your past trading and see what you do, but the odds are you're going to chase that market. So it creates those situations where you have maybe short squeeze type scenarios, to put a terminology to it that's going to make sense for a lot of people. In this case, this is the last low that was holding. You had this big run up. Everybody sees that huge run up and they're like, okay, where do I get in the market? Then you have all that price action from that point forward. So the reason I would single that level out is, think about anybody long from that point forward. Anybody long in anticipation of higher prices. So they see this huge move. They come in, they possibly get in somewhere around here, somewhere around here. The overall lows of that retracement become a very logical location because it's the last kind of short-term low you have in the area. If you're going to try to get your stops beyond the absolute low, that's another 45 pips away. For short-term traders, it's unlikely they're going that far away. So that, to me, becomes a very logical location if they are going to drive the market up for a stop run long. That's why I was happy to trade short into that, because again, I'm looking just for the move kind of down into it. It's a little more aggressive of a move, a little more aggressive of a setup, and something that is still facilitated off of number one, identifying a valid level, identifying a kind of peak in the market that creates the stop run or the pop in the market. In this case, it was created on news, drives the market back down and gives us a good signal or a good bias for at least the next short-term move. I would expect further push in that direction. So not a bad short there on the euro either, or the dollar Swiss. And as far as today is concerned on the euro, I think that we're in a situation where we could definitely see a little bit larger rotation up. We'll have to wait and see how the market opens on Monday. But obviously, an opinion is just that. Still need to see a manipulation point hit, valid stop run, and confirmation of that time. So we'll see what happens there. But that'll wrap it up for this video. If you guys liked the video, be sure to hit the subscribe button, like button, leave a comment. Let me know what you guys thought. If you have any questions on the setup itself, different aspects of it, different aspects of the bank trading strategy, feel free to leave a comment or shoot me an email. I'll be happy to get back with you on that. Also, you can check out the site, daytradingforexlive.com. Ton of information on the site, as well as a breakdown of the actual bank trading course and members area, where you can get a little more information on what I do on a daily basis in regards to this strategy and the actual bank trading course itself. So, again, hope you enjoyed the video, and I'll see you all back for the next one. Until then, happy trading.